Hello and welcome back to another episode of Fun Friday with a very special guest today, of course, as always on the show. We've got the co-founder of Driftwood Equity Partners, Luke Hemenover. How are you today, my friend?
I'm good. I'm good, Craig. How are you, brother?
I'm doing very well, and I'm excited to have a conversation with you today to learn more about you, your journey so far within the business, what you're looking for, and kind of the goals that you've got there as the founder of your, equity shop there. But we'd just love to get into a little bit about who you are in the background there.
Well, I'm a father of two. I'm married to my wife, Lindy, of 5+ years. I grew up in real estate. I grew up in construction. Was around multifamily, and so as a part of the portfolio that my parents sort of put out there and tried to manage, we helped with that. We helped with the laundry. We helped push the snow. We helped cut the lawns. We helped collect the rents. And I think at an early age, like I started to recognize that this is like a really nice asset to be involved with. And yet the particular market that we grew up in was not a really favorable or desirable market for that matter. I grew up roughly 50, 60 miles south of Chicago, and it's a rural area, not a lot of economic upswing, you could say. And yet there was a pocket of the town that, we had our properties. And so over time, my dad was very good about um, putting away money, paying down the loans, and those have become and continue to be a cash flowing asset for my parents. But removing myself from that environment, I took a note of real estate. I took a note of what could happen for our family, for my parents. But I knew that being in better markets was important. I knew that there could be far more upside in the right market over time, compounded over time. And so it's for those reasons that I've taken, a nice earning wage. I've put it to work in various apartment buildings throughout the country, frankly. But the focus in recent years here has been Texas, and you're not wrong. We now have a equity group that we've put together. It's called Driftwood Equity Partners. We've gotten involved in a number of properties, 5 to be exact. They have been nice cash flowing real estate entities, and something that I would really impart on many people that I interact with. Real estate, multifamily real estate, it's a great way to grow your wealth.
I love that. And you kind of mentioned before just the timetable, in a very quick period of time, Driftwood, group has, very quickly amassed a nice portfolio going. So we'd love to learn about those opportunities and the deals that you with your partner Matt are in. Shout out to Matt. Hope you're doing great.
Matt?
Yeah, I would love to learn a little bit more about those deals that you're in right there and kind of, why you chose those opportunities.
Yeah, first and foremost, you want to align with great sponsors, with great operators. And in the case of the 5 different properties that we're involved with, 4 of those properties are with one trusted group, Lone Star Capital, and then another group locally here in the Austin area, another trusted group that we go back many years with. So that trust to us really matters. We want to know about y'all's family. We want to know about your track record, how you've performed in your other asset classes. How do you underwrite? What are your metrics for protecting against the downside of things? When we feel good about aligning with a particular partner, that's when we want to be ingratiated in their uh, deal sourcing. We want to be ingratiated in their capital raising, ingratiated in all things that where we can bring value, help manage the asset, make introductions. A lot of folks might raise capital. A lot of folks might just invest passively as LPs. we want to think that we can add even more value to a lead sponsor. And, thankfully, my partner, Matt, very dialed in locally, as well as in North Texas, myself dialed in locally, as well as within the Midwest and over in the Houston markets. So it's for those reasons that if we can see a collaboration, and a very good one at that, coupled with a nice resume, those are the types of that. So that's like kind of where you start. And then where it progresses is, okay, how are we getting, how are we helping tell the story now to future investors? I think in the case of like Lone Star Capital, you've got vertically integrated operations. You've got a scenario where off-market offerings are, quite frankly, commonplace, and that helps attract liquid and interested investors. And so now when you have a scalable portfolio like that, now the story gets better. Now the offering becomes more complete. Couple that with great operations, couple that with really smart people. You got a winning operation.
Without a doubt. Well, I love that background there. So you're also a Texas guy, right? So would love to hear about kind of your takes on the Texas market. If I'm not mistaken, you and Matt both live in Austin, Texas. So I'd love to learn kind of about, the markets, how you kind of, view them between, I would say the main four, which is, DFW, Houston, San Antonio, and Austin.
Dallas-Fort Worth, it's no surprise, is growing by leaps and bounds. It's a hyper-competitive price per unit has increased substantially over the last couple of years, but it's for good reason. You know that this is a huge landmass that we're still kind of filling in the pockets. And I think at last clip, we've got 8+ million people, in the metro area. Fascinating. I mean, when you talk to people who grew up in Dallas as recent as 15, 20 years ago, and they'll say, oh, well, Frisco, that was cornfields. Oh, well, Las Colinas, that was just that place over by the airport. Or, just these, and now Fort Worth is this like outstanding, like vibrant market, awesome young people and outstanding jobs. And so when you couple great transportation, okay, the roadways are really impressive, and people can navigate that entire metroplex quite easily. You couple that with corporate relocations, attracting young people, very capable colleges nearby. I mean, it is no surprise that Dallas is doing what it's doing. And we're very bullish on Dallas. Investors should be very bullish on Dallas. It's a great way to park your money at the very least. In my heart of hearts, we believe that this is much of the future of Texas and the South for that matter. If you move over to Houston, it's like super reliable Houston. That's what I think of and what we know of when it comes to Houston. Lots of people, lots of different jobs there, whether it be the energy, whether it be the energy industry, whether it be education, healthcare. Houston is a monstrous city, as we know. I believe it's a top 4 metropolitan area. And you talk about the various areas of Houston that have grown. That too is a great place to park your money, and somewhere where we have the lion's share of our portfolio. I think for reasons of zoning, there's a lot of apartments there, and they still need more apartments because there's a lot of people moving there. The data suggests that a lot of people are coming to Houston, and so it's almost as if there's a good supply and yet they need more supply. So what you know about Houston is the cost per unit and the opportunity to get in. Like there might be more trading happening in Houston, which does lend itself to potentially like more deal offerings. So you get more like looks at Houston, and that's, you know, through relationships like a Lone Star, other entities for that matter. There's a lot of activity in Houston, but I do think it's because those trades have been very beneficial to operators, because the market is as strong as it is. San Antonio, you know, we are bullish on San Antonio in pockets. There are pockets of San Antonio that are very favorable, very underserved, and they too, like these other markets we've already mentioned, corporate relocations, strong jobs, young people, vibrant economy, climate. Okay, like, and let's not sleep on proximity to Houston and Austin. And lastly, where we live, Austin. It is, you know, the last 10 years, aside from a most recent study, Jacksonville, Florida has taken over in terms of the fastest growing area of the country. Central Texas, Austin, San Marcos, Kyle, Round Rock, these are all areas that are in this neck of the woods. 10 years running, so many people moving to the area, tech industry, and what you're talking about now in terms of relocations, obviously Tesla, Samsung, Google, Facebook. When it comes to high paying jobs for young people, look no further. And so again, a great market to park your money. The barrier to entry, though, because it's has been as hot as it is much higher. So some people are a little down on Austin. They might not be wrong in some areas. They might not be wrong at all. There are pockets, however, very underserved. Plenty of development that can still happen. And it's for those reasons you can't not pay attention to Austin. So that was a very long-winded answer, Craig, but
It's perfect.
that's what we think about when you talk about sort of those four main metros in the Texas Triangle. I mean, there's so many people within this 300-mile radius. They need to live somewhere.
Yeah, well, and I'd be very curious to know because Austin's gotten a lot of publicity. I mean, I think Austin's kind of like the misfit of the country because it's, relatively speaking, and it's obviously, you might laugh at this and I'd be curious your perspective, but it's almost the misfit of Texas. Keep Austin weird. It functions totally different than a lot of places within Texas, obviously, because it's a little bit more, maybe you could call it tolerant, open-minded, but
Sure.
progressive of sorts, especially with the job market there, especially moving, with a lot of corporate companies relocating to the area. If I'm not mistaken, there's about 50,000 units coming to the Austin metro, which is about, I think, 14% of supply. Houston, which trumps, as you alluded to earlier, it's the fourth biggest city in the nation. Number one, New York. Number two, Los Angeles. Number three, Chicago. Number four, Houston, right? Has got 40,000 units. So it can take on that because there's just more people there. You mentioned zoning is an interesting thing, which is for sure, right? But we like to buy in suburban areas where they're probably not going to be buying anymore, or creating more supply, excuse me. But Austin with 50,000 units coming on, that's a very big chunk of supply. So I'm curious to know if it is, all consolidated to certain areas, if it's spread out, through the various different metros that you alluded to earlier. Is there any misnomers with regard to that? How do you kind of view that landscape? Because Austin's certainly going through a lot of turbulence right now due to, supply coming on, debt not looking the greatest, and cap rates kind of expanding.
You can see, frankly, when you drive through town where the apartments are going. Many of them parked right next to main thoroughfares. These will be, I think, solid investments for those folks. And I would pray that, they got them at a nice cost of entry and price per unit. The reality of the situation is the vintage product, many would argue, is stand to benefit from this amount of supply. If you've got so much supply like this, that what we know timing wise is going to take a while to complete. Zoning, we talked to a couple of developers in the last 6 months. Took us 4 months to get a transformer. Took us another 3 months to get the permit to install it. Stuff like that. These processes, these construction jobs in Austin take a very long time. And the contention is that rents from vintage kind of, let's call it 1990s, 2000 products, they will be able to, in a roundabout way, catch up in terms of rental charge, increase the value of those assets, and sort of hopefully this environment makes sense of itself at a later date. But for the time being, it doesn't make a lot of sense. I think that the 50,000 units you allude to is going to muddy the waters. I think those folks holding in Austin right now, though, vintage assets, there could be a nice win in this 4 to 5 years. It's a bizarre deal. I mean, it really is a bizarre deal. From the outsider looking, so now I'm interested to learn about Lone Star's perspective. From the outsider looking in, what big red flags do you see when you look at Austin? The supply, no question. But when you speak with brokers, for example, are you turned off immediately by the whisper prices?
With
Have you?
Austin, yeah, I mean,
Yeah.
when we think about Austin, we would like to be there at some point for sure. I think it would make
Mhm.
sense logically, but the numbers just make it very unattractive
Yeah.
because it's not to say we can't achieve that or that we won't do well potentially on the investment. But the problem that I see with the Austin market is all the supply coming up and the fact that although it's kind of nestled obviously in the middle of the country, it functions like a gateway market. What do I mean by a gateway market? A gateway market is like Miami, Los Angeles, San Francisco, and New York. So it's got similar
Mhm.
cap rates to that, but at the moment, it's really challenging to kind of buy into that story. So I think with all the units coming online, it's nothing anything we'd consider right now, but we do kind of foresee distress coming on because you can't have the environment we were in before, where Austin, as I said, had kind of coastal cap rates with,
Yes.
tons of unit
Yes.
supply, new units coming online, and with debt right now, something's got to give and change. So, that is a place that, will get, first in or last in, first out of a recession kind of environment where it'll be
Right.
resilient for the most part, I believe. But
Right.
I do think that it is a challenge to make numbers make sense and for us to get behind and feel comfortable with that market.
Amen. Yeah, it's interesting speaking with folks who don't um, uh, invest in Austin. Um, they've got their preconceived notions about it. What we know is there are still areas specifically that need to be developed. Um, those areas are going to win. People talk about Lockhart. People talk about, you know, uh, Taylor, Texas, which is where Samsung's posting up. Hutto, Texas. These places are along this 130 corridor, which is a toll road that Tesla has parked on, within the last 2, 3 years. And anywho, the contention locally is there's still a lot of filling in to do. Boy, those core apartment buildings, though, and multifamily that exists in the city center, a lot of supply, more coming. So it's an interesting story. It's interesting to see it kind of unfold.
Yeah, and I do think it will take some time. I do think the city can absorb those units, but I do think it's going to take some time for it to get there.
Hmm.
And the problem that we see with it is any property now that's kind of an A, let's say, or A minus, call it 2000 to 2020, well, if there's, 14% of supply coming on, new supply is always the highest point of the market, right?
Hmm.
So just want to mention that it is kind of a challenge because if you have that going on there, well, how much are you handicapping your rents? How does that make sense? Just a lot to flesh out. And, for that all to happen is fine and dandy, but I'd just rather not have it be on Lone Star's watch. We'd rather have it,
Yeah.
be in a situation where they can all deal with that. And if it makes sense to enter into that market, then we will. But I think there's a lot of people losing money right now in that marketplace because they bought the hype of it, which it's very justifiable. But now, when, the market sobers up, there's gonna be some problems to answer for.
Mm. Amen.
Yeah. So that said, would be curious to know, obviously you do multifamily, but I think you also do build to rent as well for raising, or that's something that you guys are looking for. So I would love to learn more about what Driftwood is looking for equity investments, for capital raising.
Build to rent investments have a great story, and we think that sort of that personal space, having a backyard, having your own garage, that product really differentiates itself from a garden style 300 plus unit apartment complex. And what it does is it garners a higher rent. So if you can build ground up, build to rent products, whether that be in a duplex, triplex type of setup, what we're learning is um, at the right basis, uh, with the right construction and an on schedule delivery. Who doesn't like all of those things? But if you can do those things and execute, build to rent is an impressive business model. And when you talk, why build to rent? Well, it's very hard to purchase a home right now. Very hard to purchase a home. The delta between buying a home and renting on average current day is roughly $1,000. So your average mortgage in the US, $2,800, average rent, roughly $1,800. Now, market to market, that obviously varies. But the thought is that delta, that $1,000 has been so significantly affected in recent years that there will continue to be such a demand to rent. And that supports the build to rent thesis, that supports the asset class itself. So yes, build to rent is something we're very much big on. What you notice is with build to rent though, is going to be more than likely a smaller collection of units. There aren't many 400 plus unit build to rent developments. You're talking
Well,
about
it's
a
a
lot of
lot of
land.
acreage we're talking about here now.
Talking
Yeah.
about a lot of land.
Yeah.
So yeah, you're I think kind of that 150 or fewer space type of end game community. Like I think that's kind of what we're hoping for, 100 to 150 units. We'd like to align with those properties, and we're seeking out operators, contractors, and sponsors that are also involved in that. On the multifamily side, we look for good stories. Okay, we look for downside protection, low cost basis in those awesome markets that we want to align with, and that's Dallas, that's Houston, and that's Austin. For the time being, San Antonio is on the back burner. That's not to say that pockets of San Antonio can and will flourish. We know that Boerne, Texas, right outside of San Antonio, has very much arrived, and yet we want to learn about it some more and learn about where to invest, in that suburb. But to answer your story, it's the multifamily product that has upside in a great market, the markets that we're very familiar with. And then it's also build to rent products. Yeah, no question.
So build to rent too is, just for those who may not be familiar with it, it's kind of like developing a community of like townhouses, right?
Right.
It's really more of a bridge between a house and an apartment. Because a lot of people, maybe if you're a growing family or something like that, you can't afford to rent a house or be in a house yet.
Mhm.
So you get in this build to rent community, which feels like a townhome, It's, you know, typically bigger than apartments, but it's kind of the bridge between an apartment to a home. So it's kind of that nice middle ground area. And there's seemingly a lot of people developing that right now. It's obviously cost pretty expensive to build because the land and space, you know, comes at a premium naturally.
No doubt.
But build to rent is certainly a big commodity right now in the marketplace as people are looking, you know, let's if you've got dogs or family work from home, you know, being cooped up in an apartment from time to time seemingly isn't the fit. So this is something that Lone Star doesn't do, but a lot of our partners and friends in the space are certainly pretty bullish on the asset type, just for those who are not privy to that setup. So when you do look at, you know, build to rent and, you know, multifamily deals and you get pitched, just out of curiosity, you know, when sponsors send you deals and whatnot, what is the difference, you know, between the returns? You know, do you see deals? I mean, obviously, if you're doing a build to rent community and you're purchasing it, right? Or if you're developing it, well, then there's no cash on cash. But I'd be curious to know what typically the returns, you know, you're looking to solve for with those investments compared to a multifamily investment.
Longer hold. That's the big thing. If you're getting in from day one, in which we will, you know, uh, let's assume a year and a half or 2 years, maybe 2 years plus to build it. So that in unto itself needs to align with the investor. There needs to be great communication about that right from the jump. We as co-general partners in this operation, we no question need to recognize that, but being able to all come to grips with, okay, this is just a longer timeline coupled with a maturing environment, uh, coupled with timing, you know, that's what investors can expect more times than not when you seek out a build to rent investment opportunity. We got to build it, and then we got to see it grow. We have to adjust rents. We got to fill it. We've got to cater to the residents. I mean, it's a whole sort of different business plan, but not entirely different from that of a multifamily acquisition.
Right. And then with that said, is it typically speaking for the structure of these deals, you invest in them and then following that, there's some sort of cash flow once it's obviously delivered at that point? And then do you typically look to exit it in year five? Do you try to get 2 years of rent roll on that? What does that kind of look like for, you know, the full cycle project there?
Sure, sure. The current build to rent that we're involved with has a built-in mechanism for a cash out refinance uh, after construction is completed, and that's within a 2 year time frame. And so it's almost as if like the construction is one debt product, and then you've got a secondary note on top of that, and it's scheduled in such a way to, I think, get out of your construction costs entirely, but then also reward kind of those investors. And so what happens as a byproduct of that is, in this example, 50 to 60% of dollars are to be returned, return of capital at year two, just shy of year two. And the conservative underwriting and projections of debt costs around that time, good luck, by the way, being accurate with that, knowing what we've learned from the Fed.
Terrible. Yeah.
Yeah. But nevertheless, at the 2 year mark, roughly, is when it's the return of capital. And for the next 5 years, okay, so this is a 7 year hold. The next 5 years, there is a substantial cash on cash realization and then the exit, all of which very conservative. I think the real story with this particular asset is that it is insanely conservative underwriting. We already know before the first sticks went up that this product would garner a 200 plus rent premium than what was underwritten in the pro forma. I mean, that's exciting. You know, that's really exciting stuff. So when you talk about that, that's sort of the business plan that we anticipate with the group that we've aligned with moving forward.
Right. Interesting. Okay.
Mhm.
And then, just at a high level too, I mean, from return metric and whatnot, for you to say yes to something, what are you ultimately looking for in a deal? Is it, for multifamily, is it cap rate? Is it, I think you mentioned basis, but what really does get you excited for opportunities?
Quite frankly, the back of the napkin underwriting, um, coupled with the market, coupled with the sponsor. So many investors will listen to this and they will be very familiar with the 1% rule. And, we start there, kind of frankly, probably no different than yourself and Rob and other folks that you work alongside and your underwriting team for that matter. What you know is, okay, well, if we can satisfy the 1% rule or get darn close to it, okay, well, this has a chance. Is that the only metric? Absolutely not. But when you can sort of start there and feel good about things, then look at the market, then look at the sponsor, and then start to make sense of the story. Now this is something, okay, I can get I can get really around this idea. I can get around this business strategy and this plan that we're putting forth. And so it's those things that we would encourage all potential investors to take a long look at and and consider when investing in the real estate.
Right. Very good. So be curious to know how you do vet a sponsor when you do say yes to them. Obviously, we've had the pleasure of working with you, but just
Okay.
generally speaking, I know you want to, do some background, get to know them a bit, but be curious to know what kind of gets you comfortable or uncomfortable kind of during that courtship process.
Early on, when I first met Rob, we first off, I'm come from athletics background, and what you know is the best ability is availability. And Rob was very available. He jumped on a Zoom call immediately. That turned into meeting one another. That turned into another phone call. He actually helped me craft our website, craft our documents. Um, he was very helpful in recognizing, but first off, instilling like some confidence in the new guy. Okay, that we could be of value, and here's why. Um, so the accessibility, I think, is a huge thing. Lead sponsors, operators, you need to be there for your people if you're raising from the retail investor. You need to be there for even your 1031 investor or your family office. I mean, you absolutely need to be there for those folks. So accessibility is a huge thing for our team, and we want to pride ourselves on that as well. Returning phone calls, quite frankly, proactively seeking out our investors and informing them by way of phone or email. Um, I think so okay, so you look at other things also like background and history, assets under management, exits. How many exits has this person or group been involved with? You want to make certain that they can follow through with what the offering memorandum suggests or outperform that. And so, when you talk about resume coupled with communication, and then being in the sales game, you just start to read people over time, right?
Yeah.
And there's warm and fuzzy feelings about some, and then there aren't for others. uh Rob, he's got a very nice, and yourself as well, Craig. This is not to uh not include you in this conversation. Let's talk about Dasha too. She's amazing. But there's a warmth about these people, um in groups that we align with, that give you peace of mind. And there's a calmness, there's a humility, there's a directness. You need to know how to interact and work with people, and you can you can feel that.
I love that. Well, appreciate the Lone Star there ad for sure, and
No
just the
doubt.
feel there. And to your point, about communicating and whatnot, how you did that with your investors and whatnot, all that good stuff. It really is appreciated. But even to kind of further piggyback off that, I'll say I was really appreciative when you passed on one of our deals recently. You passed on it and you said, okay, but here's why. You didn't just say no or not respond. You give us a no and feedback. And, on our end, I no is great to me and a yes is great to me, but, no response, not really knowing where, people are looking for is the hardest thing to swallow, right?
Mm,
But I love no's because at least there's, direction and it's a clear path to either working or not working together, and I can get on to the next. It
yeah.
comes to being sales. That's something I really appreciate. And that's something you did for us in the most recent deal. And all of our opportunities, generally speaking, give us your 2 cents as to, why I like it or don't. And that's really appreciated on a sponsor level. I definitely think, continuously doing that. And if you're, aspiring capital raiser and whatnot, I just can't say enough how much, some thoughtful feedback is actually really important if you want to get on a good list, because when we do have a list of opportunities and deals going on and the deal's really hot, or we found an absolute winner, I'm going to prioritize and selfishly and internally just the people who do give us
Yeah.
feedback. Frankly, like it gives us extra level of confidence that you were thoughtful enough to truly look through, give the deal an honest look, and then say no, but here's why. That's very, very welcomed and appreciated.
No question. And thanks, to you and the team. I mean, the group text recently, it's a great idea. I mean, it's absolutely a great idea. We might very well install that, with some of our repeat investors, some of our more liquid, high net worth folks. Because you do feel like you're informing them, keeping them educated, keeping them front of mind. You're not always getting a lot in return. How can we sort of get organized with that? I think that Lone Star, as well as other groups for that matter, do a nice job at, if you're at an elite level, you're getting creative as to how to stay in touch with our money, with our equity. Where is that? What are people interested in? What does their buy box look like?
Without a doubt. No, and it's just super crucial to know what people want and to try to deliver upon that. Because if you don't give an answer, then the same stuff's gonna be coming your way and you can't fix it, or if there's, an issue there, right?
Mhm.
Switching gears, be curious to know what assets you think will do well coming up. And then on the flip side, what do you think will not be doing well coming up?
Assets that will do well.
And it can be outside of real estate too, if you've got,
Oh,
any
sure,
certain
sure.
certain take that you want to really harp on. We're all ears here.
Yeah, yeah. Well, I'm not gonna try to pitch you any sort of sporting cards, rhetoric or NFTs or anything of the sort. Okay. It's going to become very obvious with the supply that we talked about earlier. Your product needs to be impressive moving forward. And so I was telling sort of this story about over the next few years during the development of all of these buildings, vintage product more than likely should be able to catch up to or get close to that A class. When those A's in the new builds finish, there's going to be a runway of rent increases, differentiation between product, and the key metric, or rather the key differentiator in my heart of hearts is going to be really quality amenities. So the Class A products with pools, saunas, weight rooms, uh, dog parks, laundry service, or excuse me, in apartment
Hookups, yeah.
hookups, um, trash service. You know, the properties we're involved with, Craig, you've got the uh, smart electronics
Yeah, tech
system,
package. Yep.
tech package. You have to have those things. And it turns out that if it isn't standard, the vintage product is going to need to catch up pace with those. I think the right operators uh, of the 80s, 90s, early 2000s products that don't have those amenities, if they adopt them, they're going to see an even greater expansion of their NOI, because your hope and prayer is that now you're operating and offering a new product to your either existing or future tenant base, i.e., we've got a runway now of increasing rents. Great. So the creative ear to the ground, really quality elite operators. In my heart of hearts, those guys and gals are gonna thrive and catch up to, as best they can, the many units that are under construction and the very obvious um, amenity offerings that those products will have. With as tough as it is to buy a home, well-paid young people are going to want to live in a nice spot. They're going to need parking. They're going to need uh, a really awesome elevator, maybe a doorman, maybe like I said, that dog park and a playground for the kids. All of those things are really important to the renter nation. That is a foregone conclusion.
Yeah, without a doubt. And then on the flip side, what do you think will not be doing well here coming up?
Well, I think the easy answer there is the sloppy operators that maybe don't adopt, that maybe don't um, progress. The really old products that have probably been hanging on, the 60s and 70 product with poor utilities within the wall, or you know bad plumbing and et cetera. Sadly, I think that a number of those are going to go away. Period. The end. I think they're going to get demolished, and there's going to be new development. But you, I think that there's going to be a rude awakening for the mom and pop shop who's had the apartment building for 40 plus years and really hasn't done much to it. That's not going to be some sort of earth-shattering development on this podcast, but it really might get exacerbated over these next few years which as much supply is coming to the market.
Yeah, and it
Um,
certainly seems that, everything's getting more institutionalized one way or another. And there's just, pros coming in, whether it be operators who, target sub 50 units, they're implementing, institutional strategies here because they may see it as a less efficient and fluid market, and they're gonna be able to scoop up some value there. We just had Axel on the show not too long ago, and he kind of spoke about how, you can make money in kind of any deals. And there's an argument to be made that there could be better spread and less
yeah,
efficient markets and less, fluidity with capital and deals there pertaining to, some of the smaller projects, and that's some of the
yeah,
people who own, 40, deals for 40
yeah,
plus years. They look at it and they're just not keeping up to date because rents have been fine, but now they look around and they're really behind because they've not implemented best practices in place.
yeah. No, I mean, how and by the way, just how competitive is it to get a deal under contract? I mean,
It's crazy.
I gotta believe in the hyper competitive markets that Lone Star puts offers in on, you know, if not for the off market type of looks that y'all get, um, the mass brokered, mass marketed deals, I guarantee you're coming up against 10, 12 other, groups, are you not?
Yeah, well, I mean, we are,
And
and on their end, it makes it basically impossible for them to make the deal make sense, and you really have to stretch or pay the most because I can assure you that if you're a new operator coming into Houston, there's no way your insurance quote is within the same
no,
ballpark. It's
no,
minors to majors as opposed to what we
no,
can get on our master policy to a new group coming into that
no,
marketplace, right? So, that's not like we're the only group there, but when it comes to splitting hairs here, you're really going to struggle to make numbers make sense there. So, we totally agree. And, we'd love to buy a bunch of deals, and you were going to be a part of the 1001 Ross with us. We really like the deal on the front end, but then, when debt changed, we couldn't buy it. And that's just, it's too competitive, because the
yes,
sellers didn't want to drop the price because they know there's, typically speaking, a buyer that will pay the
yeah,
price. So, that was a unfun situation for everyone involved there, but that's just kind of a case study as to, just
yeah,
truly how competitive the market really is, and how efficient it is. And, when you get into the 50, million dollar plus building space, the 30, $20 million plus, let's just call it 20 plus, right? That's basically, middle market institutional level. They're really smart people buying this stuff.
yeah,
So
yeah.
there's very rarely, total value gap discrepancies there when these people are selling these deals.
it just furthers the idea that like you better bring it if you're going to try to take over one of these buildings and
Yeah.
offer a quality product to a quality tenant. Because just the process alone of acquiring it, you've got to, you got to be able to box out 10, 12 other groups, have the capital, bring it to close, uh, negotiate with conviction. That it's so much more competitive than it was when I first started getting involved, learning markets very, very obsessively, 5, 6 years ago. I mean, it's so competitive. And so, that for the capital raisers out there, align with good people, man. Align with good groups and competitive groups, well capitalized, great communicators, people that do what they mean and mean what they say. Try to make
Yeah.
sure I got that right.
Yeah, I know. We know the idiom for sure. Well, thank you so much for coming on the show. Last question I like to ask people is, what is your hottest real estate take or hottest take that you would like to share with everyone?
Sure, sure. This isn't a earth-shattering take. I imagine a number of people have heard it already, but investing in real estate isn't about timing the market. It's about time in the market. When this, we have investments in a couple of different cycles, and that's done on purpose. In many cases, 3-year stagger, 5-year staggers, etc. So the idea being is that each cycle you've got unlocked new capital if or when a projected exit happens. And we know that we're going to take our capital and snowball it into another deal. And then when that cycle's over with, we're going to snowball it into the next deal, hopefully by way of 1031, right? And kick the can on taxes. So this is, in theory, a small example of time in the market. And if you're in the right markets, our contention is that your money's in a very safe spot with safe operators backed by safe jobs and hopefully responsible tenants. This is the idea. This is kind of the business logic around apartment investing, and we would highly encourage anybody, if you're on the fence or if you wish to seek out more counsel. Craig is a great starting point. I'll gladly take the call if you wish to get involved with Driftwood Equity Partners. But time in the market, man, we firmly believe it.
Yeah, I love it. Well, with that said, give yourself a shameless plug. Where can people find you, reach out to you, and connect with you if they want to learn more?
Driftwood Equity Partners is on a number of socials. We have launched in recent months our video series, and it's educational. It's in essence reporting some of the current event news in multifamily real estate, in debt, in supply, and in demand and economics. But we can be found on Facebook at Driftwood Equity Partners. We can be found on Instagram. We can be found on LinkedIn, all of which are at Driftwood Equity Partners.
Very good. Well,
But thank
yeah.
you, man.
Yeah, absolutely. Well, thank you so much for coming on the show. For the audience listening to this episode, we really appreciate it, and we'll see you next week. Peace.